Hey everyone, it's Alissa Coram here. Now, whether the market is in a strong uptrend, a correction, or chopping sideways, traders always want to know where's the action headed next. And market wizard Mark Minervini shared his take on the stock market action, the macro picture, and what he's seeing in leading stocks to help him determine how to position his portfolio. Take a look.
I look at the market in two ways. One is that what the indexes are doing, and the other is what the individual stocks are doing. And then I compare those two and look for how wide of a gap we have there. When it really comes down to it, if you're trading individual stocks, you need to look at individual stocks. Obviously, if you go to the store and the lights are on, the doors are open, a big sign says "Come on in, we're open," and you go in and there's no merchandise on the shelves, you can't buy anything, right? So that's the situation we're in now. So even if the market indexes were to rally here, if there's not many stocks meeting your criteria, well, then you're going to have to be sidelined. And I think that's where a lot of people go wrong. They look at the indexes and they let the indexes be the dog that wags the tail, however you want to put it, and it should be the other way around. So I'm looking at the individual stocks right now. There's not much really in viable position. Fortunately, we got very conservative on the market on August on the 3rd of August. And started actually at the end of July, started to deteriorate. And then on the 3rd of August, that's where we really sort of hit the bid and started getting very cautious on a short and intermediate term basis. And I've remained pretty much in cash ever since. So I got out pretty good this time, and now just waiting for things to stabilize here.
So on the index level, was that because we did see the NASDAQ with a first close below this shorter term moving average? The green line on my chart is the 21-day line, coupled with the fact that that decline of almost 2.2% came in heavy volume, and then it just couldn't recover. It couldn't bounce back immediately after that. Was that what you were looking at there?
No,
Coupled with the action underneath the surface, I'm sure.
yeah, I mean, it just coincides with that, but quite
Mm,
frankly, it was purely based on the individual stocks.
got it.
Because our SPY model is still hanging on to a buy signal right now, although it has deteriorated in recent days and this last week has raised some cash. We had a January 13th buy signal, so that's in jeopardy of going on a long-term sell, which sometimes happens when you get these longer term quote unquote models. They'll go on short-term corrections, they'll go on sells right at the low. We're looking at a very oversold condition now. You're coming down by the 200-day moving average. You're getting some of the longer-term models that are getting close to sell signals. Sometimes that marks the low, and it's just the price you have to pay, to stay in gear with a longer-term trend. That's looking at just the indexes, looking at the SPY coming down to the 200-day here. But like I said, the individual stocks right now, there's still some work to do here. I don't think that we're going to have a bunch of setups emerge, in the next couple of days.
Right. Yeah, I was actually going to ask you about your index model and looking at S&P exposure, because if the individual setups aren't there and we do get some sort of oversold bounce, would a bounce off of the 200-day line or thereabouts, if we get a little bit of confirmation of strength, be an opportunity to add an index ETF in your view?
Well, again, like I said, it's deteriorating right now. So as we come off here, the my particular SPY model is getting more bearish. So it's going to bend with the trend. It's not going to bottom fish and buy at the 200-day. It's going to bend with the trend. And right now, the trend has been moving against us. So we'd have to see some upward movement. And that's the thing when when you're using trend type following mechanisms, you're never buying at the low or selling at the high.
Right.
But that's the
Exactly.
price you pay to stay in gear with a longer term trend. With that said, it's also going to be where I'm never going to get caught in a big decline because I'm going to get out and bend with that trend, or I'm never going to be out of a big rally because I'm going to bend with the trend on the upside.
Definitely makes sense. And Justin, speaking of wanting a confirmation of strength to the upside and institutions leading the way, we definitely have not gotten that signal yet. And the market rally hopes, per IBD's definition of a market rally, seem to hinge on the NASDAQ here, and it's kind of on the ropes.
Yeah, and I'll be honest, even if the Nasdaq, let's say it had a follow through day today, I think it would be a little suspect with I mean, it could be up 1.25% and still be an inside day and have all of the other indexes below
Right.
their lows and not in position. When you get those kind of divergences, it kind of gives you mixed signals. So, you know, all the other indexes are looking much, much worse. And again, this really has to do with the breadth issue that we've been kind of highlighting. In fact, on that breadth issue, something that's interesting is, when Mark mentioned August 3rd, you can kind of see right there, yeah, right there is where the breadth really started, taking a little bit of a nosedive, and it's it's been doing that since. There's really been very little reason to to think that stocks were coming back in a big way, because they just haven't really rallied in that breadth. And so I think we really need to see that so that we can get that merchandise. So yeah, a lot of times, we keep on saying this. October, it might have a lot of bottoms historically, but that doesn't necessarily mean the beginning of October. You can
Right.
get a lot of pain first. Sometimes there's that capitulation where it's like finally, everyone throws in the towel, and that's when you get your bottom. So it's best to be on the sidelines for that, because it can get a lot worse before it gets better.
So Justin brings up a good point, around that August 3rd, where breath started deteriorating. Of course, prior to that, you had already seen a big divergence between the percentage of stocks above their 200-day moving average. I've
Yeah.
talked about this over and over for some time, and I often bring this up. But when you get to a point where the market, meaning the index, is well above its respective moving average, in this case the 200-day moving average, and you've had a good rally, and you're below not only the 50% mark, but you're in the 30s. In this case, I think it was the low 30s. In 40 years of doing this, I've never seen the market survive that. And every time I see that scenario, I usually bring it up, I tweet it, and sure enough, we get some type of correction or we enter a bear market. And that's the situation that we've just had right around that time that Justin's pointing out.
Hmm. And Mark, so from here, what signals are you looking at? Clearly, more participation would help, but it does seem like we've been in an environment where the macro headwinds have really been impacting equity performance, whether it's the strong dollar or rising treasury yields. So are you looking at those for not as buy signals or sell signals, but as clues? What clues are you looking at?
So I would say on a fundamental level, on a macro fundamental level, my canary in the coal mine right now is the 1-year treasury yield. And that, you can see, has been moving up along with the 2-year, and the 10-year has recently broken out of a consolidation, and that's what's unnerved the market. And that's the higher for longer language, and the realization that rates are not coming down. As a matter of fact, they may actually go up. So we've been talking about transient inflation, and everybody's been saying, well, inflation's coming down for like the last several years. So the market is realizing that this is not materializing, and that it's a wait and see situation right now for the Fed. And the Fed doesn't want to. I mean, the Fed could slow the economy down and raise rates even more, but they're trying not to cause a breakage, if you will. And that's, there's risks with that. There's certainly a risk by waiting, and inflation could then rear its head. But again, it's at this point, most of this is on the table. It's not unknown, and the market has discounted much to the upside, and now it's discounting back to the downside. And we're probably just in a correction within a new uptrend. And that we'll probably see a year-end rally at some point. Going into the end of the year is historically the strongest 2 months are coming up, and we've had a pretty good correction. As a matter of fact, historically, when you've had a good first half of the year and you rally into August, or you rally up to August, then you have a correction in the August period, you usually get a pretty strong rally at the end of the year. And if you take a look at the cycle work and the presidential cycles and things like that, they favor, a stronger end of the year here. But doesn't mean it has to happen, and it doesn't mean that we don't slide further before we capitulate.
So if you are seeing what you want to see in those shorter term yields, and you're starting to see setups, and you're starting to see the market repair itself, then I guess the question becomes, how aggressive are you going to be with your buys at that time?
With everything I
If the
just
stars
said,
align.
yeah, with everything that I just said, I mean, a much easier way than to try to figure out, what the Fed's going to do, and the Fed is really looking at the employment picture, the labor market. That's the real issue here, because usually when you get a slowdown, you get a recession, you get a bear market, unemployment rate moves up and it moves inverse with the market. And this time it did not. When we correct it, the unemployment rate has stayed low and the labor market has stayed tight. And that's the big problem here. And that's why you've got these yields up, and because without that development, the Fed is still going to stay tight or pat. But with all that said, a much easier way, and this just goes back to O'Neill. Bill O'Neill didn't try to figure out what the Fed was doing and all these things. He looked at the daily Dow and the indexes, looked for follow-through days, and then bought stocks that were coming out of bases. And when they started working, you add to the positions and you scale yourself up into the evidence that you're seeing strength coming from those leading stocks. And that's the way I've been doing it for the better part of almost 40 years. I've been doing this for 40 years, doing it wrong for the first 5, but over 30, doing it correctly and being successful at it. And my success has come from really sort of putting that noise in the background and really focusing on the stocks. And your question was, when am I going to ramp it up, get aggressive? I'm going to get aggressive when I start seeing some stocks not only setting up, but then my buys are working, and let the evidence of the actual money, the trades that I make, tell me when to put that money and to add more risk. It's just completely illogical if you're losing, to add more, good money after bad. So I just like with what I said with bending with the trend, I bend with the evidence of the traction that I get from my own trades and what's coming from my own watch list.
Thanks so much for watching that clip. I really hope you enjoyed it. Now be sure to subscribe to my channel so you can stay up to date on all the latest. Thanks for tuning in, and I'll see you next time.